All right, everybody. Welcome back to Strongman Personal Finance. I am Christopher Bell, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser. It's on Amazon for $3 or $10 for the hard copy. And hater of bad investment advice and charlatans on YouTube. If this appeals to you, subscribe to my channel because I'm going to give you no BS advice to actually build your wealth. And to do that, go ahead and Google VTETF and open a Roth IRA, and you'll thank me later. Now today, we're going to talk about what makes a stock cheap. Now, there is a lot of misunderstanding out there about what constitutes a cheap stock. For example, you see people see Tesla dip. Let's say Tesla is at 650 and it drops to 600. Well, Tesla must be cheap now because the price dropped by $50, right? Or somebody will say a penny stock is cheaper than Berkshire Hathaway because the price is lower. I'm here to tell you that the price in and of itself, the number, the absolute value, has nothing to do with how cheap the stock is. Because cheapness is measured based on the price that you pay, measured against some metric. It could be earnings like net income, it could be free cash flow, whatever you want to use. That is what determines cheapness. Now, I have an example here for you, ladies and gentlemen. We have Square Stock on the New York Stock Exchange. Its current price is $264 per share. Now, let's go compare that to Berkshire Hathaway stock. $419,000 for every freaking share of this company. Now, if I was to ask a noob, or like Meet Kevin or somebody, which stock is cheaper, of course he would go with Square Stock because the number's smaller, right? I mean, 264 is much smaller than 419,000. Well, you're freaking wrong, okay? Cheapness, like I said, is measured compared to some kind of earnings metric. Now, let's look at it from a different perspective. When you buy Square Stock, let's say you pay $264 for Square Stock. What are you buying for Square Stock? You are buying a certain amount of earnings because you own a piece of the company. That company as a whole makes a certain amount of money every year, and you are entitled to a piece of that earnings. So if you really think about it, for example, Square Stock, let's see what their earnings per share is. So if you were to buy one share of Square Stock, you would get 71 cents of earnings. So, let's see what the price to earnings ratio is. Well, it tells us right there, $369. What that means is to buy $1 of Square's earnings, the actual money they make, you have to pay $369 for $1 a year, okay? Now, you may think that's crazy, but it's a growth company. And what's happening is people are factoring into the future that, well, earnings are going to grow super fast, so that price to earnings ratio is a little misleading. But think about it that way. For every investment you buy, the price doesn't mean crap. It's the price compared to some kind of metric. You can use price to earnings ratio, price to free cash flow, whatever you want. But think about it. If you have $264, or actually, well, that's the price of a share. But if you had $369, would you invest that to get $1 per year? Is that a good return on your investment? I would say no. I would say it's complete freaking trash. It doesn't matter that Square Stock is $264. Would you want to spend $264 to get 71 cents every year? That's freaking ridiculous. Compare that to Berkshire Hathaway, where you spend $419,000. Man, that's so expensive. Let's go look at Berkshire's financials. What are their earnings per share? $66,000 per share. With, why don't I have a freaking P ratio? That's weird. But the earnings per share is $66,000. So we can actually calculate their P ratio, where you take the price of the stock, very expensive, right? Divided by the earnings per share. Boom. So for the case of Berkshire Hathaway, all you have to do is pay $6.34 to get $1 of earnings. That seems pretty cheap to me, okay? Berkshire Hathaway, that's trading for $419,000. And yes, they're showing the Berkshire Hathaway B shares, but they're the same freaking thing. They're going to have the same PE ratio. I would rather pay $6.34 for $1 of earnings every year, as opposed to $369. Okay? Do you see the freaking difference there? Don't ever tell me that a stock is cheap and then I go look at it and the price is low. That doesn't mean anything. It's all relative to the amount of earnings, okay? I hope you learned something, and I hope you actually use this going into the future and actually use some of these ratios and metrics to really determine whether a stock is expensive or not. Now, if you're looking at a large cap company, you can compare the price to earnings ratio of the S&P 500 index to see if the stock is cheap, okay? Now also, just because a stock has a low PE ratio doesn't necessarily mean it's a good buy. You actually have to do more analysis, which, I've done in other videos, discounted cash flows, good projections, good stuff in, good stuff out, stuff like that. But you really need to look at metrics, okay? And not just look at the freaking price of a share, because that literally means nothing. I don't give a crap what a price of a share is. And on top of that, most brokerages offer fractional shares. So if you want to buy into Berkshire Hathaway, which is run by Warren Buffett, he's not even a boomer. He's like I don't know what he is, silent generation. You don't have to spend $419,000, okay, to get a share of Berkshire Hathaway. You can buy a fractional share with probably $1 at your broker. So going into the future, never judge a stock simply based on its price alone, because it's irrelevant. All right? Hope you enjoyed that. Smash the like button, subscribe to my channel, tell your friends about me, and buy my book, okay? If 2,000 people a month buy my book, I can retire. Come on, just think about that. Be generous. Anyway, talk to you later. Have a wonderful night.